Welcome back to the New York City Multifamily Podcast. I'm Seth Glasser. Today, our guest is Brian Mansouri from Secure Properties. What's up, Brian? Thank you for joining us.
Hey, Seth.
Brian is joining us today to talk about kind of like an obscure part of the real estate business called DSTs, Delaware Statutory Trusts. This comes up in our business a lot when clients want to do 1031 exchanges, but they've never done it before, or they are not comfortable buying another apartment building in New York for management reasons, and they don't know anything or not comfortable putting all their eggs in one basket with triple net leases, and they want to kind of diversify themselves into more of a REIT type structure where they're getting like a little bit of everything, and they definitely want no responsibility and no management whatsoever. So I thought it would be a really interesting and fun conversation to have Brian on here, who runs Secure Properties and is handling the DSTs over there. So thank you, Brian, for joining us. And let's get into it. I'm excited to learn. I have a lot of questions.
Let's do it.
Why don't we start very simply with what is a DST? Why was this created? I find it most popular in the conversations around 1031s. Do you have to do a 1031 into a DST? But like just broadly, start telling the audience, what is a DST?
There's a lot of misconceptions about what a DST is out there. And I think a lot of people claim to know or think they're supposed to know what it is, but don't actually know what it is. And it's really very simple. A DST, or a Delaware Statutory Trust, is a trust structure that allows individual investors to own fractional pieces of institutional quality real estate. The most enticing and I think the most attractive thing about DSTs and the way that they're most utilized today is that you can defer gains associated with a recent sale of real estate by investing directly into a DST. So much like a traditional 1031 exchange, folks have the opportunity to roll all their proceeds, gains included, continue to defer taxes, invest in something where they'll have a completely passive stake in.
How is a DST different than, let's say, a REIT? So you have, right, if you could invest in, let's say, three different things, you could do a DST.
Yeah.
You could buy a publicly traded stock like a REIT, or you can buy a CVS yourself.
Yeah.
How should people kind of think about how those three things are different?
Sure. And that's a good question. I think these are the obvious options that folks have when thinking about investing in real estate. Starting with the public REIT, obviously, I think the biggest distinction is investing in a public REIT most typically involves you investing fresh cash to purchase stock, whether it's a public REIT or a non-traded REIT. It's still pretty simple. You've got to take cash and invest in the stock.
Right. You can't do a 1031 and buy stock.
Correct.
Okay, got it. So that, from a real estate perspective, bye-bye.
Yeah, that's out. If you're tax driven and you're selling real estate and you want to figure out what to do with those proceeds and you're incentivized by deferring your gains, the REIT's not going to be a solution.
Right.
I think that's very simple, that distinction. The other option, which you laid out, is to invest in a single tenant piece of real estate on a long-term net lease, which in a lot of ways is very passive. And I certainly don't want to sit here and say DST is right for everybody. DST is better than investing in a net lease asset, because for some people it's not necessarily better. But it is in a lot of ways more passive. And I think that's the way to think about it. If you have a client or an investor who really, just got off of a 10-year run with owning a multifamily asset and had to deal with, all the ins and outs of what that takes, and they're looking to segue into something that's truly passive, and they don't want to even think about anything. They don't want to have to worry about sourcing an acquisition, underwriting an acquisition, structuring a transaction, closing on a transaction, standing behind the debt if debt is needed, which I think is a big one and we can get into.
Yeah.
You can avoid all of that by just going into a DST. The other thing I would say is when it comes to DSTs, you have a plethora of options out there. There are about 100 DSTs in the market right now today.
100?
100.
Okay.
And that spans every asset class: multifamily, industrial, net lease, retail, medical office, you name it. So you have your pick of the litter in terms of what type of product you want to go into. Maybe you're a multifamily guy and that's all you know, but for whatever reason, you don't want to be long multifamily anymore and you want to go into a new asset class, but you don't know the first thing about that asset class. You can find a DST within that asset class, find a sponsor who you have the opportunity to underwrite, and you determine that sponsor knows what they're doing. They're, strong in the space. Their track record is attractive. And that's a sponsor that you want to invest alongside of. You can use that as a way to, diversify your holdings, and go into that new asset class alongside an institutional sponsor with a track record.
So are you investing a little bit more in the jockey? Like that's figuring it, like that put together the DST? Because if I'm thinking about like our typical client, they're nervous, they've never done it before, they have tax consequences. So this is all like with my 1031 brain going here. They typically have a debt component to replace. Sometimes they're selling 2 buildings with 2 loans on it, and the LTVs might be different. Maybe there's partners involved, and one guy wants to do this and the other person wants to do that. The DST, there's 100 properties on the market. Like I've never searched for a DST to buy one. Like I've been on LoopNet, I've contacted brokers to like buy individual properties. But like, where does this database of DSTs live for like the average person to kind of explore? And then we'll get into like what they should look for.
There is no LoopNet of DSTs.
Okay, got it.
So it's not that simple. You can't go online. Maybe there should be, and that's an interesting thought. But really, you need access to either broker dealers or registered investment advisors. Those are kind of the gatekeepers of product. And it's not too hard to access those people and access the offerings once you kind of get introduced to a few of them. And we're at Secure, we're a sponsor, so we're the ones putting together the DSTs, we're structuring them, but we use broker dealers to distribute our products. So again, they're like the gatekeepers or the brokers, if you will, of the offerings. And it's certainly not as central in terms of where the offerings are and how easily accessible they are to traditional real estate. But again, like once you get connected to a few, you'll be able to see the world of options fairly easily.
And how does that work? Like if I'm just starting out and I walk in the door and I'm like, hey, I think I want to do a DST, like what do I even look for? Like I wouldn't even, like, where do you typically point people to begin?
Yeah, it's a good question. I think this is becoming more and more of a trend as the space becomes more and more institutionalized, because the majority of the folks that are coming into DSTs are individual mom and pop retail investors. But again, like the institutions are coming into the space. And I think there's becoming more and more scrutiny on the sponsor. And I think that's the right path for the space to go. I think historically it was a bit more binary, like, oh, I can defer my taxes, I can go into this passive thing, like, cool, I'm good.
Right.
And I think more and more as time goes on and the market continues to institutionalize, folks are getting smarter and smarter about, well, I don't know if that sponsor necessarily has done anything in that asset class. Like, here's this sponsor who has this multifamily deal, but all that they've done to date is industrial. Why should I put my money in their multi-deal? They don't have expertise there.
Right.
So I think like that obviously seems very simple, but that wasn't necessarily the way in which people thought about DSTs historically. Again, it was more binary. Like I'm going to use this product to defer my gains, call it a day.
It served its purpose, but like you kind of never really thought about it.
It was
after
structure
you did it.
deferment first,
Right.
Deal sponsor second.
Got it.
And I think that shift is happening as we speak.
Okay.
Where people are more focused. Like everybody is obviously there for the deferment, and that's there. But there are more options, and there are better sponsors entering the space. And I think so. Your initial question was, what should people be looking for? I think first and foremost is looking for a sponsor that they like within an asset class that they like. There are sponsors who have multiple offerings out at one time. And I'm not saying that you need to marry yourself to one sponsor necessarily. I think that would be, putting all your eggs in one basket, which is not necessary. There are plenty of good sponsors out there, but that would be, in my opinion, like the best way to start and really understanding kind of what the options are and who, to your point earlier, is going to be your jockey.
Right. And so you guys specialize exclusively in net lease DSTs.
Correct.
Okay. So I guess if you weren't specializing in DSTs, this is kind of a question that I'm thinking about if I wanted to do a DST, but maybe I wanted some diversity into like hotels, apartment buildings, whatever. Is the sponsor of the DST actually running the apartment building, like from a managerial hands-on perspective, or are they third partying it and just basically collecting asset management fees? What is the actual sponsor in a typical DST responsible for, and what are they not responsible for?
It depends on the asset class, and I'm not going to get too far into the weeds on that because, again, it depends. But I think you can think about it the way that you think about any, like investing with any other like general partner in real estate.
Okay.
Whether they're outsourcing some of the property management, that's up to them and the way that they're structured as a sponsor. But at the end of the day, all of that is their responsibility to manage. So in our case, obviously, it's very simple. We do net leases, we acquire the building, we have a long-term net lease in place. We need to oversee the tenant and anything that pops up, but it's relatively minimal. The further and further away you go from a net lease, the more responsibility there is. But again, it's managed in a same manner that you would expect it to be managed in a traditional real estate transaction.
Got it. A typical net lease. Okay. So like for you guys, when you're buying triple net leases, maybe buying is the wrong word, but setting up the DST, why would somebody invest in your DST versus buying the asset themselves?
Well, I think size and access to quality is the key component there. Like, take your typical, I don't know the average size of a transaction that you guys do.
Let's just say $10 million.
We have a DST out. The asset is a $40 million single asset.
Single asset DST. So this is not like a consortium of assets across
Correct.
the country. It's not like one CVS, a Wendy's, and you're kind of pooling it together. This is one asset.
Correct. There are certainly DSTs out there that comprise multiple assets, as you alluded. We are most likely going to be focused on single asset DSTs. We think it's easier for folks to get their heads around, and we want to make sure that we're presenting an offering that is easy to absorb and compelling in that respect.
Got it.
But yes, our asset, I probably can't get into too much specifics. Our DST in the market right now is an institutional quality asset with an investment grade tenant in place on a long-term lease. I think your average ticket size on a 1031 exchange coming out of whether it's multi or net lease or whatever it is significantly smaller than that. The options in the net lease arena for smaller price points as far as quality is concerned is likely pretty much inferior to like the quality of the asset that we're able to put together and offer it to investors.
Got it. Okay. So you're offering, right, because if I'm in a small 1031, I have to buy maybe something kind of secondary or tertiary, like meh quality, but you're saying I could roll my proceeds from my exchange into your DST and get, the Times Square location or whatever.
Correct.
Right? Got it.
And then also I think diversification is key. Like, let's say you have a $3 million exchange and you don't want to put all of that into one asset or one asset class even.
Yeah.
You can ID multiple DSTs. You can ID a multifamily DST, an industrial net lease DST, a medical office DST, and then all of a sudden you have exposure to 3 different asset classes, 3 different geographical markets, and within those DSTs there could be multiple assets owned within them as well. So all of a sudden you have exposure to an array of different assets and different asset classes in different markets. You also can mix and match. You don't necessarily. Some people I think it's binary. Like, I'm either going to do a 1031 exchange into a traditional real estate asset, or I'm going to do a DST. That's not the case. You can put $2 million of that $3 million exchange into a net lease asset, direct deal, and then you can put the other $1 million into a DST. And so you can mix and match that way as well.
Interesting. Okay. And then when these DSTs are, like, if I'm investing with you in a DST, are you going out and like buying the property with my money, or do you guys already own it and it's been under your asset management purview for the last year or two, and then you're just kind of like taking my money and recycling somebody else's out? How does the actual process work of like, when do I come in? What happens if somebody else wants to come in a month later? How does that work?
That's a great question. There are two ways simply I think it can happen. Either, to your point, like a sponsor like us could recap an asset through DST, for lack of a better term, where we take an asset that we've owned for some time, and either we just extended the lease or we did something where, it's ready to be monetized. We could utilize DST to exit it, or you can just buy an asset on the market or off market or whatever, but a new asset that you haven't owned previously, close it into a trust, into a DST trust, and then thereafter you go and syndicate the equity. I think the misconception that's out there is like, if you're a DST sponsor, you have this thing that is a DST, and then you just like put assets into it. Brokers will reach out to me and they'll be like, we have this asset that we think could be really good for your DST. And I'm like, well, I'm not going to create.
Sounds like they want a very high price.
Yeah, exactly.
That's
exactly right.
Right?
That's exactly right.
Perfect 1031.
More often than not, that pitch doesn't lead to a successful deal, but it is a good indication of how there's a lack of understanding of how a DST works. Like the trust is put together to capitalize an asset or specific assets, trust by trust. There isn't this trust sitting there to absorb assets on an ongoing basis.
Talk about everyone in New York is so paranoid. They're like, well, what can go wrong? And what's the fine print? How do you make money? I want to get into that a little bit.
Sure.
If you're making fees on all this stuff, like, why wouldn't you just create 10 DSTs? There's 100 on the market. You have one on the market right now. Like, why not create 5 or 10 and try to create more market share?
Ideally, we are bringing multiple DSTs out into the market, but the market is very efficient, and there are a lot of options out there, and there have been a lot of sponsors who have failed their investors in the DST space. So the market again is like institutionalizing naturally, and there are a lot of barriers to entry in terms of not just becoming a sponsor in the space, but bringing deals out that will resonate. So we can't just. It's not as simple as, oh, we have this net lease deal and like, let's just DST it.
Right.
It needs to really work. The numbers need to work. The structure needs to work. The financing needs to work. The yield profile needs to work. In net lease, the credit profile of the tenant is paramount. Like These investors want to see investment grade, like true quality credit within tenancy. And, those deals are hard to come by. A lot of our AUM is sub-investment grade product that wouldn't resonate with a DST investor. So, we think about it like, for us specifically, it's kind of complementary to what we have going on already from a cost of capital perspective.
I'm assuming I can't just go tomorrow, like start a DST, right? What sort of licenses or qualifications or like barriers to entry exist for this type of product?
Yeah, so no license required to be a sponsor, actually, because you have folks in place, like I said before, that distribute your product. So those are the SEC registered people. They're the ones who are vetting and standing behind the offerings on behalf of each of the investors. But the barriers to entry are substantial, and they're more structural and reputational than like legal and compliance driven. It took us probably about a year to get ourselves in a position where we were ready to launch. And a lot of that is going through with, the different distributors, managing broker dealers, what is the type of company that pretty much sits between us and all the individuals that are distributing our product to investors.
Those are the people that are licensed.
Correct.
So you're not actually going out and soliciting me, as an example, to invest in the DST. There's somebody in between you and the person actually writing the check, investing.
Accurate, yeah.
Okay, got it. Are you hiring that person or company, or is the investor, approaching that person? Talk to me more about like that relationship, because there's 3 people in the party. There's me, the guy in between me and you, and then you.
Yeah, so I don't want to complicate it further, but it depends on the sponsor and how they set up their distribution network, how much they have in-house and how much they don't. There are a lot of sponsors out there that have their own broker dealers as like a subsidiary or an affiliate of their like investment company, and they leverage them exclusively to distribute their product. For us, we don't have any of that. We have what's called a managing broker dealer who we have engaged on an exclusive basis to distribute our product. They have relationships with then broker dealers who have the reps and the advisors on their platform to go and, bring in the capital from direct investors. So
Okay.
there are multiple layers. And again, I didn't want to complicate things, but there are multiple layers between us and the actual investor before the dollars kind of flow into the DST.
Is that so you guys can run and hide in case shit hits the fan?
Absolutely not. There is definitely someone in the middle, and if lawsuits happen,
Yeah.
and we get roped in.
Well, let's talk about like what can go wrong.
Sure.
So I don't know what I don't know. Brian, what typically can go wrong, and like how do you solve that issue?
I think it's actually really simple. I thought about this before we spoke. Like, there's no difference between what can go wrong in a DST versus what can go wrong in a traditional real estate investment. Market cycles can go against you. Interest rates can rise. Something can happen to your tenant or your tenants that was unexpected. All of those things that can happen in traditional real estate investment can happen in a DST. So I don't think there's any unique way to think about what can go wrong just because of the structure. Again, like, this is really just a different ownership structure. It's not anything else. It's not a different type of asset. It's not a different risk profile. The only thing I will say is that, any varying real estate investment opportunity or structure comes with varying levels of liquidity. A DST is extremely illiquid. Illiquid.
Okay. Let's talk more about that.
The best way to think about the trade-off is you're coming into something that's completely passive, and in exchange for that, you're giving up all your control. You invest in a DST, your dollars are there. There is no real secondary market for DST ownership. It exists, and we would facilitate that type of sale, but more than likely you're taking some sort of discount unless if something phenomenal has happened with the asset or the assets during the tenure. So I think that is that's a big distinction that everybody should know when going into a DST.
That's a big deal.
Illiquidity.
Yeah. The couple of things that people kind of flag in my limited conversations with DSTs are liquidity, fees, like, your fees, which I want like the audience to kind of be aware of, like how you guys get compensated.
Yeah.
And then aligning their 1031 with your offering. And I'm talking about timing, equity requirement, as well as debt requirements. Because most of the people that are selling real estate, at least in New York, have a debt requirement to replace. That could be a 10% LTV, or it could be a 70% LTV. So why don't we start with how you guys get compensated? So let's just put some light on this, and then we'll go from there.
Yeah. So for us, which is as a sponsor, which is different from everything else that we do at Secure on like the private joint venture side of things, we are compensated completely via fees. There's upfront acquisition fee that comes to the sponsor, ongoing asset management fees that come to the sponsor, and then a disposition fee at the end of the DST when the asset is eventually sold. There's no promote, there's no upside, so everything is baked into those fees. It's all extremely clear and upfront. But the obvious issue with that from an investor is lack of alignment. Mm-hmm. And I think that goes back to what I said earlier with regards to finding the right sponsor and really aligning yourselves with a sponsor who has shown a track record of success, doing the right thing, understanding their market, understanding their asset class, and potentially even getting in with a sponsor who you've had the opportunity to meet with and speak to and really get to know, as opposed to just looking at a deal on paper and investing in it.
If I was thinking about investing in a DST, I've seen a million setups of apartment buildings, net leases. What do I see from you? And like, are there guaranteed returns? Like what does it look like? What are those typical returns? Like if your average net lease cap rate for kind of like a down the middle deal is a 6 cap, are these comparable to that, higher than that, lower than that?
So there's no guaranteed returns. What I'd say is that, especially the way that we structure DSTs, everything is relatively predictable and structured up front.
Okay.
Where we're buying assets with long-term net leases in place, and putting on long duration fixed rate debt. So, to the extent you can rely on the credit, again, we're looking at investment grade tenancy. You can underwrite the risk of something going wrong there to very minimal.
It's kind of priced in, just like every normal
It's risk.
real estate deal, right? I can buy a 4-cap DST that's super high quality, or
Correct.
like a 9-cap DST that's maybe some crazy value add deal and maybe slightly speculative.
Exactly. I'd say like the typical range for annual distribution rate within DSTs is somewhere between 4% and 6%.
Okay.
And again, that depends on risk, leverage, et cetera. But that's typically where they tend to fall if they're traditional DSTs that are levered, at a normal LTV.
Are there any risks for me if I'm in a 1031 and I invest in your DST? What happens if somebody else screws something up? Is that even possible? Like,
what do you mean somebody else?
Another investor, right? If I give you $1 million and I own 5% of your DST,
Yeah.
can the other 95% ownership of that DST negatively impact me? Is there any? No?
None of you have any control, so
Okay.
they can't do anything. Like, we have full control over anything that happens to the DST. It's, as an investor in a DST, all you have is the economic benefit of owning a piece of the trust.
Okay.
You have no control. You cannot get into it. You cannot do anything. You cannot influence it.
You are all the way in the back.
Correct.
You are. Yeah, you're just along for the ride.
For better or worse.
Yeah.
Exactly. But you don't have to worry about anything like that either. Like in a tick, for instance, I think it's like the opposite of a tick as well, right? Like in a tick, you got to deal with, 80 different opinions on the going in, coming out. This removes all that friction. You won't even know who the other investors are in your DST. All you'll know is, the collateral, the sponsor, the business plan, and the cash flow, which will come to you on a monthly basis.
Okay. So when you guys decide to sell the assets, if let's say there's 3 assets in a DST, are you selling one and keeping 2, or are you just kind of closing down the fund, so to speak, and everything, and the DST is being wound down? And I'm asking that from like a tax perspective, because if my basis was 0 in what I sold and I 1031'd into your DST, can I do another 1031 out of your DST into another DST
Yep.
5 years from now or whatever it is? How does that work?
Yeah. You can, that's a good question. You can 1031 exchange out of the DST into a DST, back into a regular real estate asset. So you can go back into active ownership if you want. So you have full optionality the way that you did coming into the DST when you exit.
Got it. Okay. So in that sense, it's flexible.
Yeah.
And then let's talk about the debt requirements here.
Yeah.
So do you want to walk through maybe your example of the DST that you're doing now? You've got debt lined up for this, presumably, or is it all equity?
Debt's already in place, and it's just under 50% LTV in ours.
Okay. So let's say I have a 1031. You've got a, let's just say for argument's sake, a 50% LTV requirement in your DST. If I'm in a 1031 and let's just go 2 different examples. One building I'm selling, I'm 25% levered, and a different building, I'm 75% levered. How should I be thinking about my debt requirements that I have to satisfy for my 1031 if I'm investing in your DST when you're taking 50%, but I have a different LTV that I have to replace?
So if you're above my LTV, then you're going to need to either supplement it with additional equity like you would in a traditional 1031 exchange, or find a different DST that's going to match your leverage if you don't want to come up with more equity.
Got it.
If you're below, then that's obviously more easily solved. You just take on more debt from an LTV perspective when you exchange into the DST.
Okay, so your debt terms that you're working off of dictate what I can and cannot do.
Yeah, you can't, there's no manipulating our capitalization to accommodate your debt requirements in your exchanges.
So when you guys are out on the market with a DST, are you trying to be hyper competitive with the other 99 DSTs? Like, are you kind of like comparing what you have versus what they have and kind of like thinking about what to buy, how to price it? Or is that like not a thing?
I think understanding our competition is just like anything. Of course, that's important. We entered the space knowing and feeling confident that our expertise within our specific asset class would resonate with the community, and that we would be able to bring differentiated product approach underwriting to the space. And, we are confident that will resonate, and it has resonated with the DST investors. If you're a sponsor and you're thinking about the competitive landscape, I think as long as you're bringing out like well purchased, well underwritten, and differentiated product, then the market will react accordingly.
Do you ever get approached to do like a customized package? So like, let's say, because we have clients all the time that are in like, they have a $50 million portfolio. They don't really want to go buy they don't want to do it themselves, basically, is what it comes down to. Do people ever come to you and say, hey, like, I have $50 million. Can you be my babysitter effectively and like fund manager and like set up a portfolio for me? Does that exist? Like, is that a business model that you guys have considered?
More and more as we continue to establish ourselves in the space and have more and more dialogue directly with investors and broker dealers, those opportunities are going to come up, and we've started to have those conversations. In those situations, though, like my advice to people isn't to structure a DST and go through all of the hoops of all of that and eat all the fees associated with that. I would just structure a partnership. We could manage it on their behalf, and they can, own the real estate.
Yeah. What, speaking of partnerships, people own assets in all different forms, right? LLCs, S Corps, C Corps, partnerships, limited partnerships. How does that existing ownership that I'm exchanging out of impact what I can and cannot do with you?
I would say, without getting into the specifics and giving any sort of tax advice, the same rules typically apply in terms of like, if you're dropping out of an LP position in an LLC, like you can't separately 1031 exchange into a DST the same way you couldn't 1031 exchange into a traditional real estate asset. So I think the same rules apply, and it does matter what you're coming out of and how you're coming out of it.
It does matter.
Definitely matters.
So are there any scenarios where I cannot exchange into a DST?
I think that's the easiest example. Like if you own if you're a limited partner, if you have a piece of an LP in a joint venture, you can't 1031 exchange out of that by yourself. But you couldn't do that,
right? But if my whole LP, if
the whole capitalization,
right? The entity that sells is the entity that buys, right? The whole LP with 5 people, the 100% of that LP invests with you. It's all good.
That's all good. But you can't as an individual.
Right. I can't pull my 2% out of my whole partnership and do that. That I know. How does reporting work? Like if I invest with you, like who do I talk to?
Yeah. So you would talk to us.
Okay.
We distribute quarterly investor reports like we do on any transaction, and that's standardized in the DST space. So you're getting monthly distributions and quarterly investment reports, investor reports. To update you on, in our case, obviously very simple net lease transactions. We collected rent, the tenant's still operating, everything's fine. More nuanced deals with more hands-on asset management. Obviously, those reports will be more robust, but you're getting quarterly investor reports.
Quarterly investor reports, distributions. Thank you. This was insightful. Are you guys out there raising money right now for a DST? And if so, like what can you share with the audience that's not confidential, and how should people reach out to you if they want to learn more about this or if they have follow-up questions?
Yeah, so we are out raising money for a DST right now. We're in the middle of structuring another one as we speak. Our goal is to have one in the market at any given moment in time. They will all resemble one another to a certain degree. We don't intend to stray from our expertise. We're net lease investors, and we plan to continue to lean into that and structure DSTs around net lease assets. I can't get into specifics at all about the offerings, but I'd say I'm sure you guys are going to put my email up. I'd love for people to reach out. We can answer questions about DSTs in general, about ours, and put folks in touch with broker dealers and, different sponsors who we think have interesting offerings within different asset classes that we don't have. We're fully open and are looking to connect. So
yeah, you guys are like really resourceful and advisory. So I think people should feel free to reach out to you, right?
100%.
If they've got more questions. And
100%. We're trying to grow within the space, and we're always trying to build our network out. And, it's a relationship business, no matter where you sit within it. So it's important to us to keep connecting.
Yeah, cool. All right, Brian Mansouri, Secure Properties. This was awesome. Thank you very much. I really appreciate it.